In this video, we're going to talk about moving averages. But before we get into a discussion of moving averages, it's first important to reinforce some basic guidelines needed to locate trading opportunities. First, following these guidelines should make it easier for you to locate trading opportunities in general. But second, you'll also more clearly understand why traders even care to use things like moving averages in their trading. So let's get started. When identifying trading opportunities, we recommend that traders follow two basic guidelines. First, we recommend that you identify the direction of the trend. If the market is trending up, we recommend looking for buying opportunities. If the market is trending down, we recommend looking for selling opportunities. This guideline is arguably much easier to abide by than our second guideline, but even still, it's often neglected, and we do highly recommend that you closely adhere to it. When you follow this guideline, the rest of your trading approach often falls right into place. The second guideline to identifying trading opportunities is to identify the right times to sell and when to buy. This may seem a bit obvious, but it's true. Knowing when to buy and when to sell is quite important. This step is often much more challenging than locating the direction of the trend, but there are many technical tools that a trader can use to assist them with recognizing when to buy and when to sell, and we're going to focus on one of those technical tools in this video, moving averages. Moving averages are technical tools that simply measure the average price or exchange rate of a currency pair over a specified period of time. For example, if we take the closing price of the last 100 days, add them together, and divide the sum by 100, we've created a 100-day simple moving average, or SMA. Most charting packages include other types of moving averages to include an exponential moving average, or EMA. They work the same as simple moving averages, except they place greater weight on the more recent closing prices. The process of calculating an exponential moving average is more complex than that of simple moving averages, but fortunately most charting packages calculate them automatically and instantaneously for you. Moving averages are typically used to get a clearer picture of the general trend of the market. You may also use the price of the market itself, but sometimes excess volatility can cloud the picture, which can result in confusion about the underlying direction of the trend. For example, without a clearer picture of the market, some traders might want to buy here, here, or here, which seems to be lows and possibly good buying opportunities. But using moving averages are a way to take a step back and look at a longer view of market sentiment. Because they represent an average closing price over a certain period of time, they do have a tendency to filter out any excess market noise. We can see here that the 200-period SMA is actually trending down. And if we really zoom out and apply a trend line, it becomes even more clear that the market is currently trending down, and we should most likely be looking for selling opportunities, not buying opportunities. One of the most popular technical indicators used in trading is the 200-day simple moving average. This tool is used in nearly every market traded today. Many times you'll hear members of the media refer to this indicator because typically the biggest traders in the world are also using it and reacting to those situations when the market moves up or down through it. Here's a daily chart of the euro-dollar with a 200-day simple moving average plotted on it. This chart shows how market participants will use the SMA in their trading. When the market is trading above the 200-day SMA, the market is considered to be in an uptrend. When the market is trading below the 200-day SMA, the market is considered to be in a downtrend. So traders will keep an eye on this SMA and note when the market moves through it as an indication of potential trend change. The best trading environments can be found when the market is trading below the 200-day SMA and is also moving down. This is considered a strong downtrend where many traders will look for selling opportunities. Traders also look for situations where the market is trading above the 200-day SMA and is also moving up. This is considered a strong uptrend where those same traders will look for buying opportunities. Going back to the previous euro-dollar daily chart, we can also see when the market will at times move to the 200-day SMA but not be able to move through it. On this particular chart, we can see that in December of 2008, the SMA offered some strong resistance as the euro-dollar moved up to but could not move up through the SMA. This, of course, is a very bearish signal and was followed by a move down of over 2,000 pips in a matter of just 3 months. These are two of the more popular ways of using moving averages, to note the trend of the market and to see how possible support and resistance are setting up in the market. Traders will use a variety of values to calculate moving averages on their charts. However, it's important to select the right chart time frame and moving average period that best suits your specific trading style. Another popular combination is a 10-day exponential moving average on a daily chart. The chart below shows an example. This is typically used by short-term traders who use a shorter time frame chart to identify their entry and exit in the direction of the trend on the daily chart. This combination is quick to note reversals, which is key for short-term traders who want to trade with the momentum of the market. With this example, using a 10-period EMA, traders will still first look for the direction of the trend, or whether price action is above or below the moving average line. After locating it, they'll then wait for price action to break through the 10-period EMA and then back again in the direction of the trend, like you see here, 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 and here. Each time the price action breaks back through the EMA in the direction of the trend, traders can look to enter the market. With this specific chart, we can see that 4 out of the 5 entries in fact did move in our favor. Only the last entry, which in fact turns out to be a change in trend, does not move in our favor. Other popular values include the 20-period, 50-period, and 100-period moving averages. It's important to note that if you plot a 200-day moving average on the daily chart and then change the time frame to an hourly chart, the package will automatically adjust the moving average to reflect the time frame of the new chart. So for example, the 200-day simple moving average on the daily chart adds the closing price of the last 200 days and then divides that sum by 200. That number represents the current value of the indicator. But if you then change the time frame to an hourly chart, the charting package will automatically be updated by taking the closing prices of the last 200 hourly candles, or bars, and divides that sum by 200. If you change the chart once again to a 5-minute chart, the charting package would add the last 200 5-minute closing prices and divide that sum by 200 to calculate another 200-period simple moving average. So this allows the trader to automatically see the general trend of the time period they wish to see in their trading. Let's close with one more way we can use simple moving averages to set up a trading approach. Some traders like to plot more than one moving average on their chart. So for instance, they'll have a 20-day simple moving average and a 100-day simple moving average on the same chart. They'll consider the trend down when the fast SMA, which in this case is the 20-day SMA, is below the slow SMA, which in this case is the 100-day SMA, and both are moving down. They also consider the trend to be up when the fast SMA is above the slow SMA, and both are moving up. This is similar to the use of the 200-day SMA example we talked about earlier, but may be easier for traders to note the stronger trending moves. Some traders will also look at the crossovers of the two SMAs as a potential signal to enter into a trade in the direction of the crossover. So when this crossover occurs, we can simply wait for the candle to close in the direction of the trend and then go short. But typically these signals are only effective in strong trending markets. When the market is range-bound or moving sideways, taking these crossovers as signals to enter into a trade are known to lead to many losing trades. Traders will refer to this situation as getting whipsawed, as the market seems to reverse as the signal to enter is generated. However, using these tools to help identify the direction and strength of the trend and to also note possible support and resistance can be a valuable addition to a solid approach to trading the FX markets.